Welcome to the deep dive.
Mm.
Look, if you're investing, it it sometimes feels a bit like you're driving with your eyes closed, right?
Ah, yeah, that's a good one. You're moving, but where to?
Exactly. Are you even going the right way? Are you making any real progress? That's really where understanding your portfolio's performance comes in. It's like your essential compass.
Mm-hmm.
So today, we're diving deep into that compass
Hmm.
portfolio return. We're pulling insights from uh, a really interesting new piece, Understanding Portfolio Return and Investment Performance by Pro Stock Tracker. Just came out July 3, 2025.
Fresh off the press.
Yeah. And our mission here is to really break down what portfolio return actually means, why what it's so critical for your financial future,
Absolutely.
and how it plays such a central role in building that long-term wealth. Doesn't matter if you're just starting out or, you've been doing this for years.
It really is like your financial report card. That's a perfect analogy. It's the thing telling you, plain and simple, if your strategy is actually working. Whether your goal is growth or beating inflation or just saving for retirement down the line.
Without it, you're just guessing.
Pretty much, yeah. Flying blind, like you said.
Okay, so let's unpack this. What exactly is portfolio return? Like the basic definition.
Well, simply put, it's the total profit or loss, right, across all your investments, everything you hold.
Everything. So stocks, bonds.
Yeah, stocks, ETFs, bonds, maybe crypto, mutual funds, whatever's in there. It's about the whole thing, the entire portfolio over a specific time.
Gotcha. So it's not just about how, say, one tech stock did.
No, definitely not. It's designed to be that comprehensive measure, the big picture. It tells you if your overall strategy is hitting the mark.
That holistic view. That makes sense. It's crucial.
Exactly, for making smart decisions.
Okay, so why should you, our listener, really care about this number?
Well, because your future kind of depends on it, doesn't it?
I mean, yeah, we all invest for a reason. Financial independence, maybe retiring a bit early.
Right, or just making sure inflation isn't eating your savings for lunch.
None of that happens unless your investments actually grow and, grow at a decent rate.
And tracking your portfolio return is essential for, well, a few key reasons. First, it measures your progress towards those goals you set. Simple as that.
Okay.
Second, it shines a light on the underperformers, the investments that might be dragging everything else down, tells you where you might need to rethink things.
Ah, okay. So it helps you spot the weak links.
Precisely. Third, it shows if the amount of risk you're taking is actually, well, paying off with the returns you'd expect.
That's important. Risk versus reward.
Mm-hmm. And finally, it gives you a solid way to compare different strategies or maybe even different investment advisors if you use one.
It really is like that health checkup for your money then.
Yeah, that's a great way to put it.
If you never check in, you don't know what's going right or what's going wrong. And that uncertainty, well, it's not great for long-term financial health.
Definitely not sustainable.
So we know it's the report card, but figuring out that grade, how it's calculated, it's not always super straightforward, is it?
No, it can get a bit tricky, especially when you factor in adding money or taking money out. But the basic idea, the concept, it's just the gain or loss from everything,
Right.
divided by what you started with, your initial investment.
Portfolio return, gain or loss, initial investment. Simple enough on the surface.
Yeah, but that's, a bit oversimplified for the real world. To get the true picture, you have to look deeper.
Deeper how?
Well, you've got your capital gains or losses, obviously, but then you also need to account for any dividends you received or other income distributions.
Okay, the payouts.
Exactly. And crucially, you have to subtract the fees and expenses you paid. Those can really bite.
Oh yeah, fees are a big one.
Huge. And if you're investing internationally, you might need to think about currency fluctuations too.
Right. So it's more complex. You mentioned adding or taking out money affects it.
Big time. That's why there are more, let's say, precise methods. You might hear terms like MWRR, money-weighted rate of return.
Okay.
That one's good because it reflects your actual return, considering when you put money in or took it out. Then there's TWRR, time-weighted rate of return.
TWRR.
Yeah, that one's better for judging, say, a fund manager's performance because it takes out the effect of your timing. It just looks at the investment's performance itself.
Interesting. So different tools for different jobs.
Exactly. But the main takeaway for you listening is that portfolio return isn't just one static number. It's a reflection of time, cash flow, risk, and the mix of things you own.
Got it. And Sometimes when people talk about returns, they might mean slightly different things. We should probably break that down.
Yeah, definitely. The terminology matters. Let's hit the common ones. First up is nominal return. That's just the raw percentage gain or loss. Simple. Before you think about inflation or taxes.
So like if my $10,000 portfolio went to $11,000 in a year.
That's a 10% nominal return, easy peasy.
Okay.
But
Yeah.
is that what you really gained in buying power? That's where real return comes in. It adjusts for inflation.
Okay. So if inflation was, say, 3% that year.
Your real return is only about 7%. That tells you how much your money actually grew in terms of what you can buy with it. Much more realistic.
That's a critical difference. Okay, what else?
Then you've got gross return and net return. Gross is before fees and costs are taken out.
And net is after.
Exactly. Net return is what you actually keep. This is huge. Always, always look at net returns. We mentioned fees earlier.
Yeah, the hidden bite.
Seriously, a 1% fee versus, say, a 0.1% fee might sound small, but over 20 or 30 years, it can literally cost you tens, even hundreds of thousands in lost growth. Check those fees.
Wow. Okay, net return is key. Any others?
Yeah. Cumulative return is just the total growth over the entire period you're looking at, no matter how long. Good for seeing the overall journey, maybe less so for consistency year to year.
Right, like up 50% over 5 years.
Exactly. But for comparing things long-term, annualized return, often called KGR, compound annual growth rate, is really useful.
KGR, okay.
It gives you the average annual growth rate, smoothing out the ups and downs over time. It lets you compare, say, 2 different funds over 5 years on an apples-to-apples basis.
That makes sense. Okay, so we know what it is, why it matters, the different types. Now let's get into what actually moves the needle. What makes that portfolio return go up or sometimes down?
Right, the drivers. Well, the big one, probably the most important decision you make, is asset allocation.
Your mix of stuff, basically.
Yeah, your mix of stocks, bonds, real estate, cash, whatever. That mix heavily, heavily influences both your potential return and how bumpy the ride might be the risk.
People talk about the 60-40 stock bond split.
Exactly. That was the classic for years. Whether it's still the best now, well, that's definitely up for debate, especially with bond yields being what they are.
True. Okay, so allocation is number one. What else?
Then you've got market conditions, things you can't control, economic booms, recessions, interest rate changes, inflation. These big external forces impact everyone.
Right. The tide lifts or lowers all boats, sort of.
To some extent, yeah. Then there's investment selection within your allocation. Picking the right stock or the right fund does matter. A few bad apples really can drag down the whole basket.
Makes sense.
Also, something often overlooked, the timing of your cash flows. When you put money in or take money out.
How does that affect it?
Well, think about investing a lump sum versus dollar cost averaging every month. Or, withdrawing a chunk of money when the market's down. Those actions affect your personal rate of return. That's why those MWRR calculations exist, remember?
Okay. Gets back to that. Got it. And the last one.
Fees and taxes, we keep coming back to them for a reason.
Because they add up?
They really do. Even small fees snowball over time. That's a huge reason low-cost index funds and ETFs have become so popular. And don't forget taxes, like capital gains tax when you sell winners. That takes a slice too.
Okay, so lots of moving parts. But, hearing all this, it's easy to just focus on getting the highest return possible. But you mentioned that might be a trap.
Oh, absolutely. Yes, return is crucial. We've established that. But chasing the highest number, it's often a mistake. Don't fall into that trap.
Why is it a mistake?
Well, first off, higher return almost always means higher risk, more volatility. You have to be genuinely okay with potentially larger swings, bigger losses along the way. Are you?
Good question to ask yourself.
For sure. Second, consistency often wins in the long run. A steady, maybe less flashy 8% per year is often much better for building wealth reliably than, say, a crazy plus 30% one year followed by a negative 20% the next. Those big drops hurt.
Right. Smoother ride, less heartburn.
Exactly. And maybe most importantly, your personal goals matter more than just the number. If you need that money in 3 years for retirement, safety and capital preservation are probably paramount, even if it means lower returns.
Anyways, you're, say, 25.
You've got decades to let compounding work and ride out market cycles. You can likely afford to take more risk for essentially higher growth. It's about your specific situation, your timeline, your comfort with risk.
That's such a key point. It's personal finance, after all.
Precisely.
Okay, so bearing that in mind, not just chasing highs, thinking about risk and goals, how can people actively work to improve their portfolio return, without taking on crazy levels of risk?
Yeah, it's less about gambling on hot stocks and more about strategy and discipline.
Makes sense.
What are some steps?
Okay, first, diversify, but don't over-diversify. Spread your money around different industries, different countries, different asset types like stocks and bonds. That lowers your overall risk because not everything moves together.
But not too much. Right. If you own hundreds of things, you might just dilute your returns down to the average, and it becomes impossible to track effectively. Find a good balance.
Okay, diversify smartly. What's next?
Rebalance regularly. This is important. Let's say your target is 60% stocks, 40% bonds. If stocks have a great run, maybe your portfolio drifts to 70% or even 80% stocks.
So it's gotten riskier than you intended.
Exactly. Rebalancing means selling some of the winners, stocks in this case, and buying more of the laggards, bonds, to get back to your 60-40 target. It forces you to sell high and buy low, systematically.
Takes the emotion out of it a bit.
That's a big part of it. Third, watch those fees. We hammered this already, but seriously, opt for low-cost index funds or ETFs where it makes sense.
Yeah.
The difference between paying 1% a year and 0.1% a year is enormous over time.
Huge. Okay.
Fourth, stay invested. Trying to time the market jumping in and out based on predictions almost never works consistently. Market timing is incredibly hard.
People lose out by missing the best days.
Right? Absolutely. Missing just a handful of the market's best days can devastate your long-term returns. So, generally, stick with your plan. Time in the market, not timing the market.
Got it. And the last one.
Maybe the hardest. Keep your emotions in check. Markets go up, markets go down. It's normal. Don't panic sell when things dip, locking in losses.
Easier said than done sometimes.
Oh, for sure. But often, the best investors are the ones who just stay calm and stick to their plan when everyone else is freaking out. Sometimes doing nothing is the best action.
Discipline and patience. Okay, so those are ways to improve. What about the flip side? What are the common mistakes people make that really hurt their returns? Let's quickly list those pitfalls so people can avoid them.
Yeah, good idea. These are the con traps. First, chasing performance. Buying a stock or fund because it just had a huge run-up. Often that means you're buying high.
Buying yesterday's winners.
Exactly. Second, overtrading. Constantly buying and selling. This racks up transaction costs and, importantly, taxes if you're realizing short-term gains. High turnover rarely helps. Third, ignoring asset allocation. Just letting your portfolio drift wherever the market takes it without checking if it still matches your risk tolerance.
We talked about rebalancing for that.
Right. Fourth, the big one we just mentioned, panic, selling in a downturn. Selling low out of fear.
Locks in the loss.
Yep. And fifth, maybe the simplest but still common, just not reviewing performance regularly. Flying blind, back to your first analogy. You need to check in.
Makes sense. Those are definitely things to watch out for.
Yeah, but look, you don't need to be perfect at avoiding every single one all the time. The key is just being aware and aiming for consistency in your approach. Discipline over perfection.
That's encouraging. So on that point about reviewing, when should you actually sit down and look at your portfolio returns? How often is practical?
Generally, reviewing things thoroughly, maybe once or twice a year, is a good rhythm for most people.
Like end of year, mid-year?
Yeah, something like that. Or maybe after a major life event, new job, marriage, inheritance, kid goes to college, things that might change your financial picture or goals.
Okay. And when you do that review, what are you looking for? What questions should you ask?
Good questions. Ask yourself. Are my returns generally lining up with my long-term goals and expectations? Has my comfort level with risk changed at all? And, based on market movements, do I need to rebalance back to my target asset allocation?
Simple check-in questions.
Exactly. And, this is where tools can really help. Things like the Pro Stock Tracker service we mentioned. They can help you monitor performance over time, compare yourself against relevant benchmarks like the S&P 500, and track those important metrics like your actual MWRR or see your current asset allocation easily.
Makes the review process less daunting, probably.
For sure. Helps you see the data clearly.
So, wrapping things up here, it really feels like portfolio return is, well, it's the heartbeat of your investment strategy, isn't it?
That's a great way to put it, yeah.
It's the key indicator telling you if you're on track, if you're drifting off course, or maybe just spinning your wheels. But as we've really dug into today, it's not just about chasing the absolute highest number possible.
No, definitely not. It's about understanding the story behind that number, the risk, the fees, the inflation, your own actions.
Right. understanding the context.
Exactly. If you want to get ahead, truly ahead of the average investor, you need to keep your strategy clear, keep your costs low,
Hmm.
keep your expectations realistic, and keep those emotions in check.
Easier said than done, but crucial.
It is. But learning to read your returns, understanding what they're really telling you like a pro, that puts you in a profoundly better position to reach your goals.
That's a powerful takeaway.
And maybe one final thought for everyone listening to mull over.
Yeah.
Remember, what gets measured gets improved. Think
Yeah.
about that with your investments.